Thanks for tuning in. We've got that breaking news out of Ottawa, where the Bank of Canada has decided to once again hike its key lending rate. Economists called it, saying interest rates will rise half a percentage point, reaching a target of 1.5%. It is the bank's third straight increase in the hopes of stemming the rising tide of inflation. It was also boosted 0.5% back at the end of April, 0.25% at the beginning of March. For more, let's bring in David McDonald, senior economist, Canadian Centre for Policy Alternatives, and he is joining me from Ottawa. David, good to see you. This 0.5% hike, not really a surprise. Tell us more.
That's right, not really a surprise. Since the last hike of also half a point, inflation at that point was 5.7%. The latest data we've got is 6.8%, so it was higher than last time. And so this was anticipated. Now, the Bank of Canada, we have to remember these rates remain relatively low historically, even at 1.5%. This is low historically. We managed to get to 1.75% after the Great Recession in 2019. And so it looks like this time around, the bank is probably pushing towards at least 2%. We'll probably see that in July, which is the next announcement on July 13th. The bank believes that the neutral range, quote unquote, is between 2 and 3%, where they stop providing stimulus to the economy. And so I think they're probably pushing to get to that 2% range, with inflation numbers continuing to be fairly high over the course of the spring.
Okay, so who is this going to impact the most? We spoke earlier with our BNN reporter who mainly said people who are in the housing market, people who have line of credits, home equity, any kind of debt, they're going to feel this.
Yeah, that's right. And so it's the interest-sensitive sectors that are going to get hit by this. And so that's certainly housing, certainly home renovations, which is often fueled by home equity loans. Home equity loans and people buying houses are particularly going to be sensitive to these changes in rate hikes. Those that already have mortgages, whether they're variable or fixed rate, aren't going to see an impact from this immediately in terms of how much they pay on a monthly basis. They'll see it when they renew. And so if you're in the market to renew a mortgage that you're already in, then yeah, you will see this impact how much you pay. But if you've got a couple years left on a variable or fixed rate mortgage, you won't see this. So it's people coming into the market, trying to buy new houses. The flip side of this is that you won't be able to get as much mortgage for the same monthly payment. And therefore, the expected impact of this is on house prices. So you won't be able to afford as much house for the same monthly payment.
Sure. David, help us understand how raising the interest rate helps fight inflation, and how it's sort of a juxtaposition or something contrary is the word I think I'm looking for, because we're already paying more for gas and for food and for other things. And also our interest payments are going to go up, our mortgage payments are going to go up, our line of credit payments are going to go up. How does that help fight inflation?
Well, so the way it works is, inflation is an average of the price of the things that we buy. Now, there are parts of inflation, like the price of houses, which is part of inflation, that these interest rate hikes will put pressure on. And so the idea is that, and it's a big chunk. The price of houses is a big chunk of inflation. And so if we can drive the price of houses down by changing the interest rate, on average, we might be able to pull inflation down. This isn't going to affect gas prices, and it's not going to affect food prices, but it will affect house prices. And so if you can pull house prices down enough, you might offset the fact that food and gas prices are higher, and on average, inflation comes down. Now, the real tricky balance here is that, so you bring house prices down a bit, but what you don't want to do is you don't want to crush the rest of the economy in the process. You want a soft landing, not a crash landing. Of course, there's always, in the initial stages, the goal is always soft landing, but you never know whether you're going to end up in a crash landing where you don't just reduce the price of houses, you start to impact other sectors of the economy. You get negative GDP, you get higher unemployment, and then maybe gas prices just come down because people don't have jobs and they don't need gas anymore because they don't have a job, or they can't go on vacation because they don't have any money because they don't have a job. And so that's the real delicate balance. This is a very rapid sequence of rate hikes. And so the bank, as well as everyone else, is going to be watching very clearly what the impact is in the coming months on economic growth to see whether this is a soft landing or a crash landing.
David McDonald, senior economist with the Canadian Centre for Policy Alternatives. Thank you so much. Appreciate it.
Thanks for having me.
Okay.